What happens to your family's financial future if your active income permanently drops to zero tomorrow? Most people spend their entire lives building wealth, but they leave the front door completely unlocked. You cannot control the storms of life, but walking into a hurricane without an umbrella is financial suicide. In the developed markets like the US and the UK, life insurance is treated as the absolute foundation of family wealth. But globally, and especially in the emerging markets, retail investors make a critical mistake. They view life insurance as a mandatory expense, a compliance checklist, or a complex tax saving tool. This is where most investors fail. Insurance is not a tax hack, it is your ultimate, impenetrable financial safety net. Let's cut through the academic jargon. What is insurance? It is a highly structured mechanism for systematic risk transfer. You are effectively transferring the creeping financial consequence of a catastrophe from your fragile individual shoulders to massive multi-billion-dollar balance sheet of an insurance institution. You pay a micro fee today to ensure absolute liquidity in times of ultimate chaos. Look at this real-life scenario. Mr. Sharma and Mr. Verma both earn rupees 1 lakhs, or roughly $1,100 per month. Mr. Sharma understands the fragility of human capital. He buys a robust term plan with a sum assured of 1 crore rupees, which is about $107,000. Mr. Verma differs. He waits for a perfect time, dumping all his capital into aggressive equities. When an unexpected tragedy strikes, the both incomes stop. Verma's family forced into the brutal distress, selling off assets. Sharma's families receive a massive, instant capital injection. Their dignity and legacy remain intact. The mechanics are brilliantly simple. Imagine a 10 lakh rupee or $10,700 car. You sign a policy, a legal contract. You pay a premium, a micro fee of rupees 17,000 or $182. In return, you get a sum assured of 9.5 lakh rupees. If an accident causes heavy damage, you file a claim and the exact repair bill is paid. Millions of safe owners fund the catastrophic losses of the few. That is how global economics manage risk. If you want to build a truly secure financial portfolio, understanding these three benefits is not negotiable. Number 1. Family protection. It provides the instant liquidity needed to clear home loans and fund your children's education. Number 2. Peace of mind. It completely eliminates the anxiety of total financial ruins, freeing your mental bandwidth to take calculated career risks. Number 3. Strategic risk management. It builds an impenetrable shield around your net worth. But here is what most people completely miss, and it leads to brutal claim rejection. Insurance is a contract of at most good faith. If you hide your medical history, your lifestyle habits, or pre-existing disease on the proposal form, you are destroying your own safety net. Total transparency is your only guarantee for a legally binding, hassle-free claim settlement. But it when you are young, but it when you are healthy, and never treat it as just an investment. Now, if you are an insurance professional or a wealth advisor, this is where it gets interesting. You are not selling a policy, you are selling a multi-million-dollar corporate promise. Here is how you handle the three biggest objections with an absolute global authority. Dialogue 1. The delay objection. Situation is, the prospects want to wait for a better time or higher income. Suppose that prospect says, I don't need this right now. I am young, healthy, and I will buy it when my income increases next year. What you can say? I think you can say like this. Sir, you are assuming you can buy insurance with money. You cannot. You buy insurance with your health and you pay for it with money. Right now, your health is your currency. If that changes tomorrow, no amount of money in the world will convince an underwriter to issue this 1 crore rupees shield. We lock this in today. This is non-negotiable. Dialogue 2. The yield objection. Situation is, the prospect compares insurance purely to equity returns. Suppose prospect says, the ROI on this is triple. I can make 15% in mutual fund instead of putting money into this premium. What you can say? I think you can respond like this. You are absolutely right about equities for wealth creation. But insurance is not a wealth multiplier. It is your wealth protector. If a medical or mortal crisis hits tomorrow, your mutual funds will be forced into distress sale, likely during a market crash. This premium is micro fee you pay to ensure your highly yield portfolio is never touched. Are we building wealth or are we just hoping nothing goes wrong? Dialogue 3. The corporate cover objection. Situation is, the prospect feels secure because employer provided insurance. Prospect says, I have a massive corporate cover from my MNC. I don't need a personal retail policy. How can you respond? I think you can say like this. Your corporate cover is excellent, but it belongs to your employer, not your family. If you leave your job, start a business, or cannot work due to critical illness, that corporate umbrella is instantly taken away exactly when the storm hits. A personal policy is the only asset that stays with your family under your control permanently. At Jeevan Bima Bazaar, we do not just talk about policies. We help you build impenetrable financial fortresses. If you want to stop guessing with your money and start mastering global standard of wealth protection, hitting the subscribe button right now is your absolute not negotiable first step. Like this video to save it for your next portfolio review. Share this with a friend or family member whose financial security you genuinely care about. One share could save their family's future. And I want to hear from you right now. Drop a comment below. Are you currently a protector or a delayer? Make the right choice. Secure your legacy today, and we will see you in the next masterclass. Thank you so much.